This is topic 3, income, lesson 3C, capital versus revenue. Okay, so one of the most contentious debates in tax revolves around whether certain transactions are capital or revenue in nature. Revenue gains get taxed at a higher rate than capital gains, and so typically with contentious cases, taxpayers are more inclined towards a capital classification, whereas SARs will be more inclined towards a revenue classification. We learned in lesson 3B that the gross income definition specifically excludes receipts and accruals of a capital nature. Now, the term capital nature is not defined by the Income Tax Act, and again, we need to refer to case law precedent to assist us with coming to a conclusion. Now, a case that often gets quoted in these cases is that of FISA, and the principal analogy to come out of this case is the tree versus fruit principle. And we can understand this if we think of an apple farmer with an apple orchard. That farmer would realize a capital gain if they were to sell one of their apple trees, and a revenue gain if they were to sell one of their apples. If we apply that logic to an investment property, for example, the property itself is the capital asset, and the rents that it produces will be revenue in nature. Now, it's important to note that in terms of the Tax Administration Act, the burden of proving that amount is capital lies with the taxpayer. And when building any case, there is subjective and objective evidence which needs to be applied. If we're looking at the subjective tests, we rely heavily on determining the intention of the taxpayer. And when we talk about intention, we talk about whether at the time of purchasing that asset, the taxpayer was purchasing it for investment purposes, i.e. holding it for a long period of time to earn income, or holding it for speculative purposes, so to buy and sell in the short term and make a short-term profit. We rely heavily on the intention of the taxpayer both at the time they purchased that asset, and then we have to look at whether or not there's been a subsequent change in that intention. So a taxpayer can buy an asset with a revenue intention, which subsequently becomes a capital intention, or vice versa. And that's important because we need to know what the intention is at the point of sale of that asset. Now, there are a couple of important cases dealing with change in intention, namely Stott Natal Estates case, Berea West Estates, and Founders Hill. And I want you to pay particular attention to the Stott and Natal Estates cases. So it's clear that when considering the subjective tests, intention of the taxpayer is very important. Where there are mixed intentions, we need to consider which intention is dominant, capital or revenue, and that'll give us an indication of the nature of the transaction. When looking at the intentions of a company, these can often be discerned by looking at the founding documents. So, for example, if the founding documents indicate that the company is in the business of selling cars, it's very difficult for them at a later point to argue that the sale of a car is in fact capital in nature. Then in terms of objective tests, the following factors are generally considered when deciding on the nature of a transaction. So the first one is the taxpayer's occupation. So a real estate agent has a much harder burden of proof when selling a house, as their job affords them a bigger opportunity to speculate in property. Frequency of disposals is another factor. If the taxpayer is selling 4 houses in 1 year, it's more likely that the courts will consider this to be revenue in nature versus selling 1 house every 4 years. Time period held is important. The longer you hold an asset, the easier argument you have that the disposal is capital in nature. Just bear in mind, though, that at any point, the taxpayer is entitled to realize an asset to his or her best advantage. What we mean by this is that a taxpayer might buy an asset as an investment, and the very next day, someone could come along and offer to buy it from them at a substantial profit. This doesn't necessarily mean that there's a change in intention, so we need to look at the facts of each case. The nature of assets held is important, so it's tougher to argue that consumables are held as a long-term investment. And the last consideration here is what the taxpayer does with those proceeds. So if a taxpayer sells a house they live in and buy another house to live in, it's less likely that they are trying to make short-term profits. So when we are considering the nature of the transaction, we need to answer the following 2 questions. Was the taxpayer objectively carrying on a profit-making scheme, and was it his or her intention to carry on a profit-making scheme? If the answer to those questions is yes, then it's more likely to be a revenue transaction as opposed to a capital transaction. Let's look now at some specific transactions. So when you sell a business, the sale of any inventory will be revenue in nature, whereas the goodwill portion of that sale will be capital in nature. In terms of copyrights, patents, and trademarks, we need to determine the intention of the purchaser. So did they buy that copyright intending to earn royalties over a long period of time, or are they in the business of buying and selling copyrights in the short term to make profits? In terms of damages and compensation, what we're really referring to here are insurance proceeds. Now, if you are receiving an amount as compensation for the damage to a capital asset, it'll be capital profits. And if you are being compensated for the loss of profits, that will be revenue in nature. And a case often referred to here in these type of cases is the Burma steamship case, where the question of the nature of insurance proceeds hinged on whether the compensation was to fill a hole in the damaged ship or a hole in the profits lost as a result of non-operation. In terms of debts and loans and gambling, again, we look at the intention of the purchaser. Any gifts, donations, and inheritances will be capital in nature, being classified as fortuitous gains. Just bear in mind that if these are received from your employer, it's likely that they'll be included in gross income in terms of Para C. Then, in terms of option and rights, we look at the intention of the purchaser. Again, are we buying and selling rights in the short term, or are we holding an option to make long-term gains? Lastly, if we look at shares, the primary indicator here is the intention of the purchaser, but we need to consider section 9 cap C. So 9 cap C says that if you have held shares for longer than a 3-year period, disposal will result in a capital gain rather than a revenue gain, regardless of the intention of the taxpayer. So if you've held shares for 3 years, your intention doesn't matter. Those will always be capital in nature. Okay, guys, that concludes the specific transactions in this lesson. You can now move on to the worked examples.